Warren Buffett has made $130 billion by holding stocks for decades. Jim Simons made $28 billion by trading thousands of times a day. Both are billionaires. Both think the other's approach is harder. So which one should you be doing? The data will surprise you. Here's what we'll cover. First, what investing and trading actually mean because they're completely different games. Then the time commitment, what the data actually says about who wins, the tax math that changes everything, the psychology battle, the legends of each side, and the hybrid approach that might be the real answer. First, let's get the definition straight. Investing means buying ownership in businesses you believe will grow over years or decades. You're a part owner. Trading means profiting from short-term price movements, minutes, days, or weeks. You don't care about the company, you care about the price action. Same stock, completely different games. Here's a perfect example. Warren Buffett bought Coca-Cola stock in 1988 and has held it for 36 years. His return, over 2,300% plus billions in dividends. A day trader might buy and sell Coca-Cola 15 times in a single afternoon, hoping to squeeze out $200 per trade. Same stock, completely different universes. Now here's the thing most people don't think about: the time commitment. This is where the decision usually makes itself, because the gap between these two approaches is massive. An investor, 5 minutes a month. Set up an automatic buy order, check your portfolio once a quarter. Done. A day trader, 10 to 20 hours a week minimum. That's 2 to 5 hours a day staring at charts, plus another 5 to 7 hours on research and trade review. If you have a full-time job, trading is essentially a second job. Investing is a habit. Now let's look at what the data actually says. A famous Brazilian study tracked nearly 20,000 futures day traders. 97% lost money. Only 1.1%, that's about 200 people, earned more than minimum wage. Meanwhile, anyone who simply bought an S&P 500 index fund has averaged 10.7% per year since 1957. No screens, no stress, no second job. But here's the twist: even investors don't do as well as they should. The DALBAR study found that in 2024, the average equity investor earned 16.5% while the S&P 500 returned 25%. That's an 8.48% gap, the fourth largest since 1985. Why? Emotions. Buying high when everyone's excited, selling low when everyone's scared. The market doesn't lose money. People lose money. Now here's the part nobody talks about: taxes. And this is where trading gets really expensive, because the government takes a very different cut depending on how long you hold. Short-term capital gains, anything held less than a year, get taxed as ordinary income. For high earners, that's up to 37% federal rate plus 3.8% investment tax, 40.8% total. Long-term gains, just 15% for most people. On a $50,000 profit, a trader pays $20,400 to the IRS. An investor pays $7,500. That's $12,900 more every single year, going to the government instead of compounding in your account. And it gets worse over time. Watch what happens when that tax difference compounds over 20 years. The investor ends up with over $3 million. The trader, only $1.5 million. Same annual profit, but paying double the tax rate means the trader's money compounds at a fraction of the rate. Over 20 years, that $12,900 a year turns into $1 million difference. Now let's talk about the real battlefield: your brain. Because neither investing nor trading fails because of bad strategies. They fail because of bad psychology. And the emotional demands of each approach are completely different. Traders must make dozens of decisions every single day under emotional pressure. Lose money in the morning, revenge trading kicks in, doubling down to win it back. Win a few trades, overconfidence takes over and you start taking reckless risks. See other traders posting gains on social media. FOMO makes you chase the same trades too late. Every day is a new emotional minefield. Investors face different demons, but far less often. An investor only needs real discipline a few times per decade. During the 2008 crash. During COVID in 2020, just sit tight and don't sell, that's it. The DALBAR study proves most investors still fail at this. But the bar is so much lower. Resist the urge to panic a handful of times in your entire life and you win. Now let's talk about the legends. On the investing side, Warren Buffett. 19.9% annually for 60 years. That turned $10,000 into over $500 million. Then there's Peter Lynch, 29% annually for 13 years, running the Fidelity Magellan Fund. Their secret: not speed, not technology, patience, and discipline. On the trading side, Jim Simons. His medallion fund returned 66% annually for 30 years. That's the greatest track record in financial history. Then Paul Tudor Jones, who predicted the 1987 crash and made 200% that year. But here's the critical difference: every legendary trader used sophisticated quantitative systems, PhD-level math, and massive computing power, not gut instinct, not chart patterns on a laptop. So who should do what? Here's the honest framework. Choose investing if you have a full-time job, you want to build wealth over decades, and you like sleeping well at night. Choose trading if and only if you're willing to treat it as a full-time profession, you have 1 to 2 years of living expenses saved up for the brutal learning curve, and you genuinely accept that you'll probably lose money for the first 1 to 3 years. Before we get to the real answer, let's bust 3 myths. Myth 1: traders make more money. The top 0.1% do. The other 97% lose money. Meanwhile, anyone who bought the S&P 500 index fund 20 years ago is up 600%. Myth 2: investing is just slow trading. No, completely different skill sets. A great investor might be a terrible trader. Myth 3: you need to trade to beat the market. 90% of professional fund managers with Bloomberg terminals and analyst teams can't beat the S&P over 15 years. Here's the real answer, and it's what many professionals actually do. Put 90% of your portfolio in long-term investments, index funds, and quality companies. Then take a maximum of 10% as a trading account to scratch the itch. This way your wealth compounds regardless of whether your trading experiments succeed or fail. Even Jim Simons had personal long-term investments outside of the medallion fund. Let's recap the 5 things to remember. 1. 97% of day traders lose money. This is not a game with good odds. 2. Tax drag costs traders nearly $13,000 a year on the same profits. 3. The S&P 500 averages 10.7% per year, no screens, no stress. 4. Trading demands 10 to 20 hours a week, it's a second job. And 5. The 90-10 hybrid approach lets you build wealth and experiment. Invest first. Only trade with money you can afford to lose. If this video helped you understand the difference between investing and trading, smash that like button, subscribe, and share it with someone who's thinking about day trading. Next up, value investing versus growth investing. Which investing philosophy is right for you? See you there.